Hey guys, what's going on? So 9.1% reading in CPI. Not a good look, not a good look. So that only signals the Fed to be more aggressive as we discussed in yesterday's video. So what does that mean coming into the remainder of this week and the following, leading up to the Fed meeting? I think that the markets are going to head on a little bit lower. All right, we're going to break the June 17th low. Unfortunately, that is exactly what our Elliott wave count is going to dictate. However, there is the possibility that we're still going to head on higher. So tune into this video as we discuss the possibilities. Okay, guys, so the most important thing to take away from here is that the likelihood of us continuing higher are very slim, right? And I'm going to explain to you guys why. So we're going to focus on our bearish count, and we're going to spend a little bit of time understanding where the market's potentially really heading, because as I just mentioned, CPI came in higher. The yield curve inversion is pretty critical, also signaling recession. It is likely that the Fed is going to give us aggressive rate hikes. So a lot of things are combining and lining up for the markets to start pivoting lower. We also have a surge in the dollar. I know it's consolidating right now, it's pulling back, but the likelihood of this continuing higher is going to be there. Now, if you guys remember, let me just quickly recap for you. All right, June 17th, we were looking for that to be our low, right? We were looking for this to be the wave one, a wave two pullback, and then the beginnings of this third wave. Even when we were taking our fib extensions, we saw that this was around the 618. Now, if you guys are familiar with Elliott wave counts, the second wave and its associations with fib extensions and fib retracements, you see that the wave two will normally gravitate towards the 50 to 618. All right, we found the 618 as support, and then we started heading on higher. So that gave us back here again on July the 5th. All right, that gave us a little bit of confirmation that the markets were attempting to head on higher, but we were waiting for this break of this high, and we're waiting for the equality of wave 1 and 3 to give us some sort of confirmation. You guys already know that I like waiting for a pullback in 3 waves to find support and head on higher, but ultimately the most safest way and the most conservative way to trade these things is a break above this previous high, which is the wave 1 in this case, to confirm the wave 3. Okay, now we didn't get that. We started rolling over, and now here we are. Why do I think that the markets will continue on lower? Is because, first of all, we had CPI data today at 9.1, which is higher than expected, as I just mentioned. We are going to get an aggressive rate hike coming into the end of this month on the Federal Reserve meeting, and we also got the headlines of the yield curve inversion. Pretty bad. That signals recession. So let's turn on our labels here and let's see what's going to happen, because we never broke above this trend line, as I was noting for you guys. All right, and we never broke above equality, not equality, but rather our zone of resistance that would invalidate this bearish count, which was at 400. All right, we since then just rolled over, and now we're looking to make the third wave. Okay, now let me take you guys down to the 30-minute time frame, and let's kind of dissect this. All right, let's see what these levels are going to look like and what the wave count is telling us. So from the high of June the 27th, we rolled over into the wave B, into the C, completing the wave 2. Now we're looking for this to be, let me label this for us. Okay, we're looking for this to be the wave 1, 2, 3, up in 4, and then the final 5th wave to give us confirmation that this is the wave 1, all right, of the smaller degree. Now that'll take us south of this zone, right? So the levels to watch again are going to be 373. Please write this down, or I'm just going to label it here. A break south with 373.56 is going to trigger the possibility that this is the wave 1 completion. We're then going to retrace back in 3 waves, all right? And you guys already know this is exactly what I look for to confirm, or to help us confirm the change in trend. Okay, so once we get this 3-wave pullback, that will give us some sort of Fibonacci retracement. Say this is the end of the wave 5 of about let's take a look more conservative, the 23 to 38.2. If we get 38 and 23.6% retracement, somewhere between 378 and 375, I personally will be very, very interested to take a short position here to give us an opportunity to the downside. All right, to give us more to give us more downside exposure to complete this wave 3. So you already know my preferred vehicle of profit transportation will be the SQQs, which is the inverse ETF of the triple Qs. I know I'm reviewing the SPY, but the Qs will follow. when we start getting this negative sentiment, the triple Q, the SQQQ will start going up while the triple Qs will go lower. So that's the game plan. I will wait a little longer for the break south of 373.56, then to get a retracement towards the 378, 375, and then give us the downside exposure. Now, let me take you guys over to the triple Qs, because it's exactly the same thing what we're looking for. All right, in the triple Qs, guys, here, we were looking for this to be the wave 2. So it's clear, right? It's clear here. It's more evident here than it is in the SPY, because we can clearly see 5 waves down, 3 waves up, and now maybe the 1, 2, 3, 4, and 5 to complete this wave 3. Again, break south of the previous low here, right, and the B wave, right, because this is, let me just undo all of this, because this is the A wave, the B wave. A break south of the B wave will give us the first confirmation we need to look for to give us an opportunity to the downside. Again, once the market start going down, the S triple Qs will head on higher. All right, so you guys know that's the inverse ETF. So a break south of this level 276.83 will give us confirmation. So if I take you guys down to the 15-minute time frame, this is looking more like a 1, 2, right, 3, 4, and 5. We never broke north of the wave 1 low, as you guys can clearly see here, right? So the wave 1, A, B, C into 2, right? The third wave, and now correction in the fourth, and now we will head on lower. Okay. Once this wave 5 is complete, then we'll take that third wave, the 3 wave up, like I just mentioned. So let me just illustrate here for you. Right, 1, 2, 3, 4, and 5 for the wave 1, A, B, C for the wave 2, and then the rollover. So wherever this lands, assuming that we end up somewhere here in the wave 1, this wave 2 is going to give us that confirmation and that opportunity to give us more downside exposure. All right, I'm very confident that this might be the case. Actually, let me take that back. My analysis states that I should be confident that this is going to be the case. Again, this is not a recommendation. Shouldn't take this trade if you're not prepared to lose money. All right, only because also, just going back to this, the 618 was our resistance zone at the wave 2. All right, guys. Let's take a look at the dollar, because that's something that we discussed today in this video. Let's take a look here. So the dollar is giving us a bit of a pullback, right? As we noted in our Discord group, in the daily time frame, we see that this is the wave 1, ABC 2, 3, 4, and the final 5th wave that's touching the upper bands of the Elliott wave trend channel. We also see that it's giving us divergence, right? We got a high peak here on the wave 3. All right, pull back into the wave 4, a new high with in price action, but a higher low in RSI. All right, so that might signal either the, oops, what's this? This is my video. Cancel that. All right, so 1, 2, 3, 4, and 5. And then likely either this is a cycle degree wave 1, and then we get a pullback in 2, head on higher in 3. We'll take it from there. We'll do a little bit more analysis in the wave count for this, for the dollar, but for now, this is what we're tracking. Looking at bonds, looking at the yield, 10-year yield, you see that we're pulling back into this wave 4 as expected. 1, 2, 1, 2, 3, 4, 5 to third. ABC pull back into the 4. We give it a 2.635%. Okay, likely we'll see a price action head on lower to here before we start heading higher. Thus giving the NASDAQ a little bit of pressure also to the downside. All right, thus obviously signaling TLT to head on lower too. Okay, so let me see, what else am I gonna cover here? The SMH, again, we are also heading lower for the SMH, finding some sort of resistance support, of resistance somewhere in between the 206. All right, if we start breaking south of this, all right, this is 1, 2, 1, 2, 3, 4, and 5. I'll delete this because this is not relevant at the moment. Let me just hide these guys. So let me see. So the way I'm looking at this is 1, 2, another 1, 2. Prepare for the third of the third of the third. All right, so I'm gonna leave you guys with that. I think that's pretty much covers what happened today. CPI again was pretty crazy. Look for the break of these levels that I just mentioned for us to potentially see a bounce and then on the next leg lower. All right, guys, so take good care of yourself. I'll see you guys tomorrow. Take care. I almost forgot. I have to show you the bullish count because it's not always the bearish and we're gonna head on lower gloom and doom crash of the globe. Now, this is still a possibility, right? We still may be able to salvage this idea that June 17th was our actual low. So how do we do that? Because here we formed the wave 2. Possibility that we have the wave 1. We're forcing 5 waves out of the low to this high. We then retrace back into the 618 as I mentioned to you guys earlier. Okay, if this ever cooperates. Okay, we did a 618 support here, okay, in this wave 2, and now we're looking to see this is a wave 1. Actually, this might be the wave 2, A, B, and C, right? Very, 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 very awkward C wave, okay, because this actually did this hit a low. Let's take a quick look. Actually, no. So we'll call this the wave 2. All right, a very weird wave 1, pull back into 2, 3, 4, or 3, 4, and 5, A, B, and C pullback. So you guys already start seeing, right? This is all skewed. This is all not your typical standard look for a wave 1 and 2 pullback. All right. So for that reason, if this is to be a valid count, we must hold north of the 618 and the 786. All right. Ultimately, we must not break south of our wave 1 low, which will invalidate. No, sorry, not that one. My bad. Here. See, that's why it's a long day, guys. So this will be the origin of our wave 1, which is 373.38. All right, and we cannot break south of that. So we've already noticed that we are beyond. We did go beyond the 786. Not a good thing. Not a good thing, guys. I've already expressed that to you. And then we bounced aggressively from there. From the initial drop to CPI, intraday, you guys already know that we recovered most of those losses, and now we're just rolling over ever so slightly. So that is the bullish count. That is what I think could salvage this wave, this June 17th low. But otherwise, I don't think that's maybe the case. I think by the end of the week, we're going to see ourselves rolling over into more lows here. All right, guys. So look for a break south of 373 to give you confirmation, and then turn yourselves into a bear temporarily if you are a bear. All right, guys, so thank you so much for tuning in. See you guys tomorrow.